Thank you so much for having the paper on the program. This is joint work with Aakash, Shah, and Darren from Indicia Labs, an AI company out in the Bay Area. And what we're looking at is just essentially the quality of the crypto data that many of us use basically in research and practice, all right? And obviously this year, I used to say this before, but I don't think I need to say it in this audience in this year anymore, right? Crypto now is back in. People are really excited about the crypto market. Bitcoin hit new all-time highs this year. But if you just look at kind of crypto data, this per se has become very interesting as well. So this here shows Google Trends for the term crypto data going back to 2008, 2009. It's a little stale. This is through March 2025. This is probably much higher now, right? You can see that people are looking for crypto data. They're looking at this to make investments, to understand what's happening in the crypto market. And until now, really, there was no real systematic analysis of the quality of the data sources that exist. And that's what we do in this paper. So for over many years, actually, going back to 2022, we looked at basically the data provided by a wide range of different data vendors. They include many crypto data vendors that are well known, like something like Messari, but also smaller crypto vendors like CoinGecko, CoinCap. All in all, we surveyed 20 different providers. We provide kind of documentation on like what data they provide over what time frame for which coins in which form. And then we narrowly focused on these 8 providers that are highlighted here in yellow: CoinCap, CoinGecko, CoinPaprika, Live CoinWatch, CoinMarketCap, CryptoCompare, Messari, and Sentiment. And really dig down to understand what kind of data they provide and how good that data is. And ultimately, what we find is we establish pervasive quality issues. I'm going to show you the kind of issues that we document, from measurement errors, which obviously we would expect in any setting. But the issues are much bigger than just that. They're labeling issues, they're inconsistencies, and I'm going to present a bunch of evidence on these type of issues that exist. And then what we're going to do is we're going to propose a methodology that allows you to kind of get rid of some of these data issues. So it's going to aggregate data across different vendors and use kind of the wisdom of crowds to understand what the right data is that we should be using. We're going to show the benefits of our approach for asset pricing analysis primarily. And then ultimately, we're going to develop a grading scheme to assess the quality of the different vendors and ideally guide kind of usage of these data. So our results have significant implications both for the way we use crypto data, but also potentially for regulation, thinking about the market for data in this space. All right. So I'm going to walk you through all of these results. Feel free to interrupt me if you have questions. Let's see how we go. All right, so what are these kind of data sets that we're thinking about? So we're primarily thinking about market data, and mostly from CEXs, so centralized exchanges. So think about anything like the closing price of Bitcoin, trading volumes for a given coin, open, high, low, and close candles, that kind of market cap data, for example. Those are the kind of data we're looking at. There's a much bigger data range of data, obviously. There's blockchain data. We don't look at blockchain data here. There's DEXs. We also don't look at DEXs here. So we just narrowly focus on crypto market data from centralized exchanges. And what happens in the crypto market, as you all know, right, is that a single coin can be traded on many different platforms at the same time. So you have Bitcoin, obviously, is traded on every single cryptocurrency in the world. And that means that in every different exchange, Bitcoin is going to have a different price. So what happens is that so Indicia Labs, the way they were approaching this problem, and this is what brought us to looking at this problem, is that they're training AI models, and they're trying to train AI models on unified aggregated prices. So they're not using kind of exchange prices because they're not necessarily trading, but they're trying to train models that can identify kind of patterns in data And for that, you need aggregated data, like a global Bitcoin price at any given point of time. And there are many different data vendors right now in the market that offer these kind of aggregated data series. Mm-hmm.
So, do you mean only post-trade data or also pre-trade data?
All of this is post-trade data, so these are all traded prices. Yeah. So there are all these different data vendors that I showcased before, right? That their main job is to aggregate data from different exchanges and different platforms and create single unified series for each one of the coins at any given point of time. And this is really, really difficult work, right? This is not something that you and I could do on our own, right? Obviously, if you only care about Bitcoin, maybe you could do it. Actually, for Bitcoin, it's probably the hardest to do because it's traded on so many different exchanges, you wouldn't be able to get all the data. But if you only want to have the closing price of a small meme coin that's only traded on one platform, you could probably do it yourself. But if you're looking at a large cross-section, at this point, there are over 11,000 cryptocurrencies traded worldwide. There's more than, I think, 4,000 crypto exchanges in the world. Right, this is really difficult to do. It's very, very hard to collect this data. And we see that this is the case, right? Because when you look at the providers that I outlined before, these are big tech companies. They've raised around the median deal size from pre-seed to seed to Series A and other series in the crypto world. So a company like Messari, for example, is a very, very well-capitalized startup. They've raised lots of money to be able to solve this problem, right? Similarly, Sentiment has raised money. Kaiko has raised lots of money. Crypto Compare now was bought by a big data vendor as well. So there's lots of transactions happening here. So what we argue is really that access to aggregated data is a real market need, and that these vendors really are solving for a hole in the market. So now what the problem that occurs when we have such many different kind of data vendors is that each one of them is going to take a different approach, right? So for example, CoinMarketCap may sample every single crypto exchange that exists in the world, right? But Crypto Compare may only sample 80% of the crypto exchanges that exist in the world. So the price that Crypto Compare is going to report as an aggregated price is going to be different than the price that CoinMarketCap is going to report as an aggregated price. And those different choices are ultimately going to impact the data that we see as the end user of these vendors. Right? Now, if it's only minor changes, we would expect that these differences don't matter as much. But what we're going to show is that this really matters a lot. These differences introduce lots of variation in the data. So we try to illustrate that here in these two graphs. So, these are scatter plots, and the way you want to think about it is, let's focus first on this left graph here. So the x-axis is essentially the median close price across the different vendors on a given day. So on some days, the price is going to be low, so these are going to be these data points over here on the left, and some days the price is going to be high, and these are going to be the data points over here. And then the y-axis represents the deviation of a vendor relative to the median across the vendors on that day. So each one of these dots is a crypto day kind of entry for a close price. And if everybody was roughly reporting the same, you would expect all these dots to fall on zero, right? Because or one, right? Because this is the relative deviation relative to the median. So you would expect everything to fall kind of flat here if everybody was reported more or less the same prices. But what we can see is that there's substantial deviation in these reported aggregated close prices. Some providers, X here is CoinCap, right? At times reports a close price that is almost a factor 10 to the power minus 9 smaller than the actual price. Up here, this triangle is CoinPaprika, reports a price that's 10 to the power 7 larger than the median close price. And this is not just a few data providers reporting kind of off prices. This is pervasive across all providers. There's huge deviations in the kind of prices that are reported. Some of these are going to be measurement errors, and we show that yes, there's lots of fat finger mistakes. You would think that this is crypto, it should be all automated. It's not. There's lots of human intervention here still, and we see that. We also see that sometimes some of these errors are corrected, exposed. So you load data on one day, and you load the same data another day, and you're going to get different data because they're correcting these data sets. So they're data vintages. Mm-hmm.
Is it similar to the data that would be considered by a hedge fund looking to arbitrage the differences between exchanges?
So this is different data, right? And a hedge fund that's arbitraging across exchanges wants to pull the data directly from the exchange. And you can do that, right? This is really collecting across all exchanges and aggregating and into a single series.
So if you have an entity that needs to mark their portfolio for regular, do they use one or are these vendors? Can they shop around?
They shop around.
Gives you the best price depending on what you want to present.
Yes.
As a daily market.
Definitely. So there are lots of incentives. I'm going to try to talk about this later on. But yes, so you can shop around, right? And then select the vendor you want. It depends on what kind of product we're talking to. A lot of these listed regulated products, like ETFs, for example, or anything like that, or some derivatives that are traded on regulated exchanges, they will use a reference price that a regulated provider would offer. The CME has an index, for example, a Bitcoin price index, and that's what they would use because that's validated. And another benefit of using some of those the regulated providers, is that they're transparent in the terms of their methodologies. A lot of these providers here, we surveyed, don't report the methodology they use to aggregate. So we kind of have to guesstimate what they're doing based on what we see. Right? So we observed this kind of issues consistently for any kind of price, whether it's close, open, high, low. For market caps, we observe similarly. The biggest issue we observe are trading volumes. So trading volumes are very, very inconsistent. So when you look at this, we look at kind of plus minus 5% bands around the median. For prices around 5%, 5 to 10% of the samples in a provider fall outside of these plus minus 5% bands. That's just a heuristic. It doesn't mean that these numbers are right or wrong. But when you look at trading volumes, around 2/3 of the data sample fall out of these plus minus 5% bands. So trading volumes are extremely inconsistent across providers.
Transaction or daily?
This is daily trading volume, aggregated daily trading volume. Yeah. So maybe you would expect this. And if you think about it deeply, this makes sense, right? Because the main difference between an aggregated price and an aggregated volume is the aggregated price it's an average. The aggregated volume is basically the sum, right? And the sum is going to be much noisier because every single entry matters. Here you can do some kind of robustification and exclude some of these outliers to get a more consistent price. So we find that trading volumes are very hard to aggregate. And that has, Alfred would know that has kind of implications because trading volumes matter, right? First of all, we find that we should expect that trading volumes are very difficult to aggregate across exchanges because when you look at the distribution of volumes across exchanges, it's fat-tailed essentially. So very few exchanges command huge amounts of the trading volume. So basically the distribution of volume across exchanges is well represented by a power law. What that means is that if you only aggregate a subset of exchanges, then the aggregate volume has infinite variance, so you can basically get any kind of number here. So volumes are very hard to aggregate unless you absolutely consider every single exchange. Now, why does that matter? It matters because it kind of comes back to this. A lot of the providers use a volume-weighted average of closing prices across exchanges. So if you're measuring volumes incorrectly, you're ultimately also going to get inaccurate aggregated metrics. So everything here is kind of connected, and a lot of the issues we see with volumes kind of contaminate everything else. All right. So one reason why we observe such many discrepancies is just the nature of crypto, right? Because everything is traded everywhere all the time. Aggregating this data is difficult. All right, so this is basically what I would say is something like a measurement error. You can't just avoid it. But where we see that there definitely kind of human cost kind of quality issues is when we look at kind of how these cryptocurrencies are labeled. And I think this is where a lot of these problems come in. So unlike traditional financial markets, there exists no such thing as unique identifiers for cryptocurrencies. There's no QSIP or ISIN for cryptocurrencies. So what many of these providers do is they develop their own identification systems for different coins. So it's inconsistent across providers, and it's also not often consistent within a provider. So for example, we observed that 16% of the sample on CoinGecko has the same ID for more than one coin, right? So it's really hard to figure out what data you're getting. 1/5 of the data of the sample on Coin Paprika changes the ID over time. So if you're using one ID for a coin and later on you want to download that data again for that coin, it will be a different coin. And another issue that we observe is that a lot of these cryptocurrencies go through forks or swaps, and often they don't account for these changes in the fundamentals basically of the coin. So you will observe kind of these huge jumps in the trajectory of these coins when there's a fork or a swap, because they keep the ID kind of unchanged after one of these swaps. So there are pervasive ID labeling issues that introduce some of these differences. So what that means is that this outlier here may be due to the fact that this is an inconsistent label, or there's some sort of token swap that happened that caused this issue. All right, so this is in place where we feel potentially some sort of regulation could come in place. So that causes all sorts of issues. So you're going to measure, obviously the raw data is wrong. We then look at kind of what does this mean for returns. If you compute crypto returns based on one sample and based on a different sample, you're going to get very different returns. Volatilities and even rankings are inconsistent. So you wouldn't rank cryptocurrencies the same way using different data sources. So how do we go about solving this problem? So what we do is we introduce kind of an aggregation methodology that uses a cross-section of providers, right? So in order to identify the truth, essentially, we need to observe different samples from these providers. And what we're going to use is we're going to use two different metrics to identify what the right, basically, set of providers is for any given coin. So we're going to start with a cross-section of providers, and we're going to run these providers by a first filter. You can think of this as kind of like a very loose kind of filter, where we're going to find the set of providers that are reporting consistent data based on the market cap of a coin. So why market caps? Market caps are relatively consistent. We know that there's only two approaches to do market caps. Either you do fully diluted or kind of circulating market cap, and that allows us to identify a first set of providers that are consistent. And then once we have this first set of providers that survive, we run those set of providers again through a much tighter filter based on closing prices, where we're going to use some clustering methodology to identify the set of providers that report consistent close prices based out of the subset of providers that report consistent market caps. And then once we have these final set of providers, we aggregate using the median. So it's kind of an iterative approach to figure out what the truth is in this market. In the paper, we have theoretical conditions under which this works. Obviously, in practice, it's hard to figure out whether this is working right or not, but we provide evidence that it is. For example, we find that when you look at the aggregated prices that we would come up with our methodology versus the individual prices from the individual providers, we are much more likely to fall. So we're more likely to fall kind of on the flat axis here versus somewhere on the periphery. So that's one way we measure whether we're doing this right. And then another way we measure whether we're doing this correctly is we look at all the instances where there are mislabels, potentially, and whether we reconcile those mislabelings and exclude the providers that appear to be mislabeling. And there we do pretty well. So this provides an approach that's alternative to just getting a bunch of data and taking medians or averages, because this approach is taking into account the fact that some of these providers are labeling inconsistent. So I'm running close to the end, so I want to just end on two things. So one of the applications we have in mind with this is we use, essentially, we look at how often does a provider end up in this final set of providers that we believe are reporting truthfully. And we use kind of frequencies of that to develop a grading scheme. So when we look at that, we find that the providers fare differently in terms of the quality of the data that they provide. CoinGecko here performs the worst in our setting, so we often exclude CoinGecko as a provider here. On average, it obtains a C. CoinMarketCap was a surprising one for us, fares the best. CoinMarketCap for a long time was kind of dismissed as a provider because it's owned by Binance. So there's incentives potentially there, but we found that they're often reporting the most reliable data in a way compared to the other providers. And then there are other providers that kind of fall in between. Another one that we found was surprising is Messari. Messari is an institutional grade provider. They fare kind of average in our analysis, and it's very expensive to get Messari data. So price does not equal quality in this market as well, right? CoinMarketCap is relatively cheap, Messari is relatively expensive. So where does that take us to, right? So ultimately what we kind of show is that as a user of crypto data, we don't really know what the right data is, right? And if we don't know what the right data is, then we're gonna have a hard time figuring out how to get that data. So what that means is that as a user, you need a cross-section of providers to be able to figure out what the right reference price is that you should be using. That has kind of two implications, right? Either you have to pay for a bunch of different providers, and that increases the cost to use data, or you need to rely on kind of metrics to be able to assess the quality, and that's where we think that this grading scheme can help. So for practitioners in this market, our results really suggest that it's very important to make sure you're using robust data. In the paper, I didn't get a chance to talk about this. We show how basically there's replication issues, right? If you fit, say, an asset pricing model on one data set versus another, you can get very different results. So if you're building portfolios potentially or training AI on this data, that could also have issues. For academics, obviously, there's a bigger question, right? Because many of these academic papers that are empirical in crypto use single provider data sources, so they're susceptible to some of the quality issues that we highlighted here. And then finally, for regulators, and maybe even more importantly for industry groups, the question here is whether there's some scope for a potential regulation. What we believe is that at the minimum, a unified identification approach is going to be valuable here, so that you don't get these massive outliers in the data because of labeling issues. Guidelines on how to potentially aggregate data could also be valuable. These exist in equities, right? In the US, the SEC has guidelines on how to aggregate closing prices. There's no such thing yet in crypto. And then potentially, there's, not sure whether this is even relevant anymore given the market space now, but there are questions about consumer protection in the space. A lot of these data providers recycle data from each other and they just upcharge. There's obviously questions of quality here. So to which degree is the price that we're paying for some of these data sources really justified given what we're obtaining? So I'm gonna wrap it up there, right? Let me see if you guys have any questions. Any other questions? Mm-hmm.
The follow-up paper potentially, if you look at also as other points on the chart, the actual marks from ETFs or mutual funds and see where they stack. Or maybe even try to identify if, let's say, a particular ETF is a system-based provider that matches some of the game. Mm-hmm. Or they can do this mix and match, shop around.
Yeah.
That will be a best score for that ETF.
Yeah.
They definitely show some sort of accounting games as opposed to some sort of a real investment expertise.
That's a really good point, right? Because when we last edited this paper, the only ETF that existed was a Bitcoin ETF, at least in the US. Now we have many more, right? So, and there's no unified index for other coins other than Bitcoin.
Exactly your chart, but here is that those being database providers actually daily marks that come from the ETFs.
That's a really great suggestion, Then
there is actually a regulatory problem now.
Yeah.
Because
They are going to be dispersed just because of fees, right? They charge slightly different fees, but
individual,
yeah.
holdings marks,
Yeah.
most PS will give you the daily marks
Yeah.
of the holdings.
yeah, yeah, good point. Yeah.
I think this is a really valuable paper, and I was just wondering, in traditional markets, in shares, bonds, etc., how do people evaluate data sources, or is it just kind of by reputation, or is there some regulated quality measure like what you've constructed?
There's definitely regulations. So the SEC has clear guidelines on like what is the daily closing price of a stock and how you determine that. It's a little bit easier because most of the times there is only one exchange where the stock is listed, so it makes it easier. But even in the traditional space, there exists this issue that some assets are traded in multiple places and there needs to be aggregation. But there are guidelines, yeah.
I imagine it's more complicated for bonds, which are traded over the phone,
Yeah,
right?
yeah. So for bonds, yeah, there are data sources that are that do this, right? They're institutional grade. So I guess it is partially reputation, but I don't know the details in that regard. Yeah.
In many cases, they made stuff up because
Yeah.
structured products trade once a year. So it's all model-based daily
Yeah.
marks. And there's gigantic variation of mutual funds marking the same security.
Yeah.
They may be plus minus 5%.
The London whale.
I'm gonna go back to the point. Yeah. Yeah. So that's a good point, right? And I think that's the point I wanted to make, right? In the traditional space, there's always the issue of like, you can't really do this, right? Because you are eventually gonna get in trouble, right? Here, there's none, right? Yeah.
So in EU, the obligations apply to the trading platform, the trading venue, but not apply to the venue.
Yeah.
But it's a competitive market.
Yeah.
Cannot operate if not be accurate. But there are pre and post trade transparency obligations for trading venues, which they apply them through vendors or through themselves
Yeah.
by providing them for the trade information.
Yeah.
And there is obligation also for the time they will be transparent the prices.
Yeah. For sure.
So you cannot publish after 2 minutes, and publish as much as technical possible.
Yeah. All right. Thank you.
But also in Europe for crypto asset markets, if when MiCA will apply and the trading platform will be authorized in EU, should have the same obligations.
Yeah. So Kaiko is a European-based institution. And what's interesting about Kaiko, so Kaiko and Masari are probably competitors, but Kaiko does not do this. So it's kind of like a revealed preference kind of issue. Kaiko does not provide aggregated series. They only do exchange level series. So partially, maybe because they realize this is just very difficult to do and we're not going to get into this.
That's the right place.
Yeah.
You have a menu and
Yeah.
you choose one of these 7 exchanges
Yeah.
or these 10 exchanges.
Yeah. Thank you.